Hi everyone, and welcome back to Antipodes' quarterly Magnified video series, where we take a deep dive look into markets over the quarter and the drivers of Antipodes' global portfolios. Today, I'm joined by co-portfolio manager Vihari Ross. Vihari, welcome.
Thanks, Sam.
So it's been a volatile time in markets over the last quarter. We've seen a rotation in returns and drivers starting to come from different sources relative to recent history. But the end result of all this is actually very little movement in markets overall, with the MSCI All Country World Index returning 2.6% over the quarter in Aussie dollar terms. Unpacking this at a regional level, we see US equities delivering 2% over the quarter versus just shy of 20% in the 6 months to June, versus a region like China, which did 18% over the quarter relative to its 6% in the first half of the year. And over that 12-month period, we see that China as a market has in fact caught up to where India has performed over that period of time. Unpacking the sectors over the quarter, we've seen a bit of a rotation here as well, with information technology down around 2% over the 3 months to September versus up close to 30% in the first half of the year. Mega caps in and of themselves were down slightly over the quarter versus up 25% over the first half of the year. Cyclical sectors like materials, industrials and utilities were the key drivers of performance. So it's safe to say we've seen a rotation, a broadening out of performance among companies that haven't necessarily participated so much in the concentrated markets that drove the first half of the year's returns. From July, we started to see value as a factor outperform quality and growth, which departs from the recent narrative. So Vihari, what's gone on here? Let's unpack the quarter.
Well, I suppose starting with the US, there was the big news of, probably highly anticipated, the Fed cut rates for the first time in this cycle. It was, rather than it being a bearish rate cut, it was a dovish one in terms of the commentary. But clearly, the Fed is looking at the same data that we are and observing that normalization in jobs data and, a normalization in that, exuberant spending that took place through COVID. We're seeing rising delinquencies in, the sort of higher leverage part of the debt stack in the US. And, putting all of that together, you sort of think that perhaps, part of the rationale with the Fed that, declare that they're closely looking at the data are, reduce that risk of a hard landing and maybe increase the chances of a soft landing when it comes to observing the data. I mean, the other thing I would say is the market has really repivoted its focus to the Fed's other objectives, which is around employment and growth, rather than being caught up with the direction of inflation. And I think we all know, inflation has started to decline. It's certainly stickier than it has been in the past, but nonetheless moving in a downward direction.
Vihari, I mentioned at the top that rotation in sectors and drivers of returns. We saw the market shift focus away from mega cap tech over the quarter.
Well, yeah, it's interesting. I think people were almost a little bit bored of mega cap tech, maybe with that, honeymoon phase about the exuberance of AI being over. The focus has really shifted to the scale of the capex investment that those companies are undertaking and continuing to undertake. And quite importantly, from a shareholder's perspective, what is the return going to be on those investments? And what we've sort of observed more broadly in the market is investors seeking out, alternative ways of playing that AI thematic, and that's really landed on the renewable energy sector, particularly I think off the back of, Microsoft and Alphabet or Google, establishing, purchasing agreements of nuclear energy, for example. And we've seen, portfolio holdings of ours like Siemens Energy and GE Vernova, deliver returns of, 100% over the last 6 months. That's in comparison to NVIDIA, the poster child of AI, up 50%. And over the last quarter alone, NVIDIA was sort of slightly down to flat. Both GE Vernova and Siemens Energy were up 40%.
Vihari, from a regional sense, we also started to see a broadening out of return drivers for global markets, with China, India, and even Latin America performing strongly over the quarter.
Yeah, I think, that reversal that we spoke about also took place in emerging markets. So China, as you mentioned, delivered that 18%, compared to India at 4%. LATAM also delivered positive return, but it was very focused around the less rate-sensitive parts of that market. But of course, we couldn't talk about emerging markets in the quarter without talking about China and the surprise announcement of the stimulus package coming through, perhaps long awaited, but, surprised in timing nonetheless, and, in size, in scope, and in sentiment. It's still early days when it comes to the delivery of that stimulus, but clearly it's, centred around, those key elements that are going to stabilise, the Chinese economy and then deliver that ultimate recovery, being around the property sector, being around the share market and corporate liquidity. And so you started to see that risk premium that's been, weighing on Chinese equities, start to unwind. And I think, that the willingness in particular of the CCP in terms of their commentary to, issue bonds, at the long end to fund that fiscal stimulus has been an important market for us to watch. And it shows that, they mean business when it comes to stimulating their economy.
Sure, there's a lot to unpack there, but I would encourage viewers to look out for the October episode of the Antipodes Good Value Briefing, where we take a deeper dive into the recent China stimulus measures. Vihari, over the quarter, we saw strong benchmark relative outperformance in both the Antipodes Global and Global Long portfolios, with that resurgence in China taking centre stage, perhaps over the market's prior focus on the Magnificent Seven and the tech complex. And in fact, over the quarter, the underweight Magnificent Seven actually contributed to portfolios. What else drove returns over the quarter?
So the key contributors over the quarter were, perhaps unsurprisingly, our China holdings, our investments in Alibaba, in Ping An Insurance, as well as real estate platform KE Holdings. As we described, there was that coordinated effort by the CCP in series of announcements to, signal their willingness, to support the Chinese economy, and that supported our individual stock picks there. Siemens Energy was also a positive contributor over the quarter. That's not just an AI trade that's going on here. They actually have reopened their books to new demand, for their wind turbines, generating strong favourable earnings revisions for that business, and their grid and their grid and gas business is also delivering strong results. Barrick Gold also contributed favourably. Yes, the gold price has increased in value, but there's an idiosyncratic story here for Barrick Gold as well, not just around their own investments in increasing their operating efficiency, but also in that production ramp throughout 2024 and into 2025.
Conversely, Vihari, over the quarter, stock positioning in Brazil detracted from returns, as well as a bit of a rotation in the memory cycle.
Yes, I mean, in Brazil, we have Sendas Distribuidora, the cash and carry grocery retailer. In Brazil, that cyclical upswing is continuing in terms of unemployment coming down, consumer confidence growing, but perhaps at the political level, perhaps that commitment to fiscal prudence, and the market's confidence in that has probably diminished somewhat, and that's changed the market's view on maybe the direction of interest rates and how quickly they can fall, and it has impacted companies like Sendas, which are more geared than average. And have that, decline in gearing as a key part of the thesis. Nonetheless, our conviction remains, and we continue to hold that stock. Samsung also detracted in the quarter with, some concerns around where we are in that memory cycle and how it coincides with the mega cap AI, capex cycle as well.
Vihari, let's talk about some of the portfolio changes over the quarter. Most notably, one of those changes includes increasing exposure to financials, particularly within developed markets.
Yes, Sam. So over the quarter, we took a position in Ali Financial, just a stock that fell following concerns of non-performing loans that are coming through from those that originated in 2022. Ali is a large auto lender in the US. But their 2023 loan book is much higher quality, and it's also a business that's benefiting from that steepening rate cycle as their deposit, high deposit rates they're paying roll off. It'll roll off onto lower rates. That's actually favourable for their net interest margin. We also added to our position in Capital One Financial. It's a large credit card and auto lender in the US as well, and that's a business that has the proposed acquisition of Discover Financial, and should that acquisition take place, you'll have an end-to-end, you'll have in fact the largest card processing network across the US, and they'll capture the margin across the entire value chain. In the case of both of these companies, they're trading on single-digit multiples, and also have much more favourable forward-looking outlooks than a lot of their financials peer set.
And we continue to find expressions of pragmatic value within the internet and software space.
Yeah, we've taken a new position in that space in Workday. That's an HR software transitioning to a broader ERP software business. There's a transition story yet to play out in the cloud and in ERP and sort of infrastructure as a service. As those transitions take place, the revenue uplift per customer is 2 to 3 times, and Workday's participating in that. And our analysis has shown that they're actually gaining share, in larger corporates across the US. Those Fortune 500 companies, their penetration is increasing, and this is a stock that's actually trading at a discount to its history at 6 times sales and growing its earnings at in a high teens pace.
Bahari, after the strong rally in China, what has this meant for portfolio position sizing? Has there been any trimming over the quarter in those positions?
So yes, Sam, we have trimmed selectively in China given the strength of the rally there. But overall, that market is still trading at a really compelling valuation. Overall, it's trading at 10.5 times, still at a significant discount to its history. But of course, we are watching the data. We're looking to assess, the trajectory, of the stimulus potential packages as they come through, and quite importantly for the recovery, looking for the sign of that bottoming in the property sector as well. So more broadly over the quarter, we initiated a position in Didi. That's the leading car-hailing, ride-sharing business in China. They're dominant. They have 73% market share, and they've regained a lot of the market share they lost, during their temporary ban. They restarted their operations in 2023. They're getting double-digit growth in the number of, rides hailed. They're getting increasing take rates. They're getting growth in their operations around the world as well. It's a business that's trading, again, at a discount to its history, with, that opportunity for profitability to inflect, including as international operations move from loss-making to profit-making. We also added to Pinduoduo, PDD. People will be familiar with their Temu brand that they use outside of China. So clearly a discount e-commerce retailer, and despite that weakness that the Chinese consumer has been going through, this is a business that's been taking market share, has been gaining share in terms of advertising dollars being spent on the platform, and they are getting really strong growth clearly through that ex-China operation as well, being Temu, with the profitability to ultimately inflect, being an option value sitting within that business. Elsewhere in emerging markets, we also exited our positions in KB and Itaú. There were 2 emerging market banks, in favour of those US financials I mentioned earlier. Those stocks had performed very strongly and reached our valuation targets.
And Bahari, what about some changes in the more cyclical part of the portfolio?
So within the industrial side, we trimmed Daimler Truck. That's a business where it continues to have a strong market position and continues to have that opportunity to gain share as that transition to zero-emission vehicles takes place. But the trimming was driven by a little bit of increased uncertainty around the replacement cycle. Being in industrial vehicles, you can always wait another year potentially before you buy a new truck, and there's some uncertainty there for Daimler that led us to reduce our position slightly. And we rotated exposure into Airbus, which is, clearly a 2-player market in terms of the provision of aeroplanes. The other player, being Boeing, going through a raft of issues, very, very publicly, and that's, favouring Airbus's market share. But the investment case there is really driven by that demand profile for the delivery of an increasing number of planes over time. That's driven by, population growth. It's driven by, increased demands for travel. And so airlines, pre-ordering, in anticipation of that. But also importantly, the airlines are, replacing old fleets. And that's a significant, more shorter-term tailwind for Airbus as well.
Bahari, with some of those changes in mind, it's worth taking a holistic view of the Antipodes Global portfolio. We've been selectively adding to global cyclicals with attractive supply and demand dynamics. We've also increased our allocation to developed market financials, again, as we touched on earlier. We continue to find pragmatic value expressions of key structural megatrends. These are mispriced beneficiaries of the investment in energy transition, supply chain onshoring, and names like Workday that are benefiting from the AI monetization and the shift to the cloud. The range of outcomes does still remain wide. The global portfolios retain a relatively defensive tilt So here we're looking for companies that are cheap relative to their growth profile and peers and are less dependent on the economic cycle for growth. And this part of the portfolio is anchored by healthcare exposure and some of that gold exposure we spoke about earlier. Well, Vihari, thanks for joining me today on the Antipodes Quarterly Magnified video series.
Thanks for having me, Sam.
Thanks for tuning in, and we hope to see you again next quarter.